Welcome back, everyone, to the European VC podcast. Today's conversation sits at a rare intersection point between deep climate science and deep capital experience. Marta Sjögren, and I am Danish, so I will definitely mess up the Swedish name here, is the founder and CEO of Paebbl, a company turning CO2 into a permanent mineral sink. And before that, she was also a partner at Northzone. This is a conversation about how seeing the system from the investor side reshapes how you fundraise, how you solve problems, and how you build a company when the stakes are planetary and the timelines are long. Carmel, I wanted to bring you in to say just a bit about the table because we're doing this series together to try and put emphasis on the importance of supporting women founders in this space because we are clearly behind all numbers that would be good when it comes to that.
Yes, hi Andreas, it's great to be here. So I'm Carmel. I head the table. We are a community for co-investing in women-led climate ventures. We bring together syndicates, funds, family offices, and CVCs globally to share deal flow, early stage usually, pre-seed to A, where there is at least one female founder holding substantial equity. We qualify that as an equitable stake compared to a male counterpart, no more than a 60-40 split between them because that matters. And doing anything that has a direct and substantial positive climate outcome. So sector agnostic, climate positive. And we're currently building out the Table Foundation that will provide recoverable grants. You can think of them as a forgivable revenue-based loan to come alongside our community and provide catalytic capital to the underfunded climate innovation while closing the funding gap for women.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
So, Marta, now, lights on you. I just said something with a permanent mineral sink. Maybe you can be a bit more concrete and uplift the conversation a little bit to those that actually know tech to talk about what Paebbl is.
Sure. And I'm going to warn you that there is really no shortage of puns in this space around being concrete, constructive, and a whole bunch of other things. So what does Paebbl do? We take captured CO2. We don't do the capturing part ourselves. There's a lot of good companies doing that. We take captured CO2 from flue gas or direct ocean capture, or direct air capture, and then we convert it into a stable mineral using other minerals. Basically, we get the CO2 to react with calcium or magnesium silicate minerals, and then they form new mineral. And therefore, the CO2 is trapped for a very, very, very long time. In fact, it's very difficult to untrap it. And well, what that's used for is is in the built environment to basically replace some cement. So end to end, it's a dual benefit. You get rid of the CO2 and you're replacing a highly emitting material in the market today.
So, Marta, we've had a couple of episodes with founders building in this space as well. And the continuous question that I always ask is, how tied are you to the regulatory environment and the supporting infrastructure that there is to try and help climate positive startups versus being purely commercially a great solution for the market?
So I think that's an interesting question. We are in a highly regulated market, if that's one side of it. So it's not like we can get away from regulatory either inhibitors or enablers in any case, right? The building materials market is highly regulated. You need to be certified, you need to be under certain standards. There's a lot of regulation there. Does that mean that we are tied to regulatory measures that incentivize folks to buy us from subsidies and those kinds of measures, like at the intersection of finance and regulatory? No. We're building a company that will be able to be competitive in the market without any subsidies or similar long term. We will be slightly more expensive in the first 3 years of production than what is out there in the market. However, we envisage that we will be price competitive in the market within the coming 5 years. So that's kind of without any regulatory support. That said, the market around us is also facing quite a bit of regulatory pressure. So that works in our favor. The EU ETS is one good example of this, with a carbon tax being charged on emissions and those allowances also being phased out. We are affected by any changes in schedules of that, so that the gap between how how competitive we are in pricing with or without EU ETS is, of course, there naturally.
Knowing what you know from an investor perspective, how does that bring you into packaging your offering and your roadmap in a way that's maybe slightly easier for some of the investors to make the leap forward?
So I think coming with an investor background, it has its benefits for sure, whether it's through understanding what momentum to focus on at what stage of the company, or how to package the so-called in-between stages, which are, every company goes through in-between stages. You don't quite hit your milestones, but you hit a bunch of milestones. So that is certainly helpful. I think the other component is really understanding the mindset of an investor and what do they really care about? What is it that's important to them in a negotiation? And then trying to figure out a win-win. I'm a big believer in, if there's an interest in doing something together, there's always a way, right? And if you speak investor language, so to speak, that's made easier, right? Because then you're there to just ask, hey, what are you here to de-risk? Like, what are the top 3 items that you need in our data room for your own investment thesis to be proven or disproven, whichever way around? And then making sure that the data that we have is in the right shape so that it's easily digestible. In today's world, we are inundated with data, with deals. Like I remember being on the other side, and within 2 minutes of looking at a deck, or even less than that, probably within 30 seconds of looking at a deck, I would know if I'm more or less interested. It is brutal. And now being on the other side and experiencing that now, when an investor looks at it for 30 seconds, and I track, of course, what they look at, I'm like, what? You haven't even gone through like the whole deck. Like, what is this? So it's easier in one sense, but it's also challenging in that you're trying to put yourself into the mind of that particular investor, trying to understand how educated they are in the space that you're in, and then to build conviction and build trust quite quickly. It's very interesting. I mean, I have a lot of fun, and also, of course, a lot of I know a lot of the investors, so they will just sort of say, well, you know what I'm going to ask you, and I'll say, yes, we have the answers. I think one of the fun things that may be worthwhile to this audience to share is that because I know what questions will be asked by a lot of the investors in the first instance, we kind of went ahead and built an FAQ that gets all of those questions. And then we just say, just dump it into your like whatever AI thing, and you can get all of your answers. And then, let's not waste each other's time unless you've gone through the FAQ and gotten your initial answer. So that's like a tip that I can recommend to others to do. It's very effective. You don't end up being in these like back and forth calls on things that they can just read.
Let me ask you just a funny question, because I think it's a very tactical piece of advice. How come you dump the FAQ and tell them to put it in their own, instead of giving them a link to ChatGPT and say, this is our FAQ, like you can ask anything you want, but this is the link, use that, where you have a bit more of a controlled environment? I'm asking you this because I'm sure that there's a lot of founders that are trying to figure out, are there smart ways to do this? And I can see both good things about it. And I can also see, well, the fact of the matter is that every VC has their own processes. They're not going to do anything that they're not used to doing. They trust their own GPT. They don't trust others, blah, blah, blah. So for that reason, just give them the FAQ and then they'll take it from there.
It's actually quite simple. We use DocSend as our data room, and I can track who accesses what there. So with a link, like maybe I haven't figured out how to track ChatGPT links, like to see if they're actually engaged. But I really don't like stale conversations. So we just we'll switch off access if somebody hasn't accessed a document within a certain amount of time, because I don't want them to be lurking around our data room and then coming in eventually when we're not on top of the conversation. So that's the simple reason why. There's probably better ways to do it, I'm sure.
Now let's double click on that, and this is where I think we should focus the conversation, because there are a few that have your background, and for that reason will be able to structure a fundraise process and everything as succinctly as you can. So talk about that, the importance of measuring behavior by investors in the data room.
You have your pipeline, right? You have your whatever you're using. We use Attio, for example, right now. It's just like any deal, like you're selling something or like whatever you're tracking as a pipeline. You need to be very brutally honest on what you have in that pipeline. If you have your, what sometimes startups do is like, oh, I have this amazing pipeline. It's like billions of dollars in pipeline, but actually qualified, actually the folks they're actually having conversations with is like a sliver of that. It's a few percentage points of that. And so when you have that huge pool of investors, and I can tell you we've talked to and are talking to quite a few investors, you really want to know that you're focusing your time on the right ones. So being able to kind of stalk their behavior in your data room is very important, because you will get signals. You will understand if somebody's engaged in a conversation in your process, they will be keeping track of what you're uploading in the data room. They'll be fast to react, either directly or indirectly. By react, I mean the moment they get that notification of like Paebbl has updated something in their data room, within a few hours or at most within a day, they should have access to that document. Otherwise, you have a stale conversation. So you can really like figure out where you're at in their priorities through this. The other thing you can do is understand who is a bad behaved investor. This is a particular pet peeve I have, and I'm not going to name any names because I have addressed this directly with those general partners and their LPs, actually. You do not download a data room and then set a rejection letter or a rejection email like 5 minutes later. It's just so distasteful that it really annoys me. So you can spot bad behavior as well, and then you can give them a chance to correct that behavior, or you can, use that information in other ways.
Yeah, that's obviously a very big breach of trust.
Hold on, not just trust. It's a big breach of the NDA that we all sign NDAs, and then we're very specific, everyone has in their NDAs that they will destroy the files. If they're no longer in our conversation, they will destroy that access to that information. I'm very deliberate about following up on that. I can tell you that folks don't do it increasingly. Okay. And this is, I think, very, very bad behavior that I think founders should be aware of. And it's fine. Part of our job is to educate the market, but then do tell me if you're looking to just be educated in the market, and don't waste time off founders if that's all you're doing in your face. Like at the same time, I have had some really good discussions with investors that don't have a thesis in the space yet. And then they say, I don't yet have a thesis in this space, but I'd love to learn what you guys are building. I'm going to build my thesis over the coming X amount of time, 6 months, a year. And then let's talk deal maybe then. And I'm like, you know what? That's fine. Very, very happy to do that. But the in between, the non-communication is very frustrating. And I wish more founders came out and spoke about this as well.
It's a classic that founders are like, on the one hand, you have VCs saying, dude, show me everything, because it's like the only way I can diligence this. And I am seeing thousands of deals. Why would I care about your thing? Like, I'm not about that. And then they say founder behavior. Then they say a founder reputation is everything. I would never violate your trust. All these things. Those are the VC talking points. But then in the deep tech space, especially, of course, you have a lot of founders that are not comfortable and are requiring and are trying to stage gate access and all of these things. How do you navigate that? Because the investor mindset 100%. So where have you come down on that, knowing that you have a lot of sensitive material that you don't want to be sharing everywhere, but at the same time you also know that there are some rules in the VC game that I have to adhere to?
Yeah, so we share our intro deck without NDA, and we even share like a teaser to the FAQ without the NDA. That's called Gate Zero, basically. Once we have come far enough in the discussion so the investor says, okay, interesting, I would like to dig deeper, then we have them sign an NDA, and then we let them into gate or zone 1 in the data room. This is where you have everything, all of your commercial, basic team, you don't have the very sensitive stuff, but you can do all of your commercial diligence. You can do some of your technical diligence. You can do some of your, compliance, regulatory, all of that stuff, diligence. And then it's only when you're at term sheet stage that we go into gate 2, basically. And gate 2 of the data room, it contains very sensitive materials like the results of technical diligence, results of IP or legal diligence, all of the stuff that basically you're paying some kind of a third party to do external diligence on you. That's post-term sheet for obvious reasons, also because then you're kind of in deal mode.
There is a usual VC saying, which is, data rooms are where deals go to die, but obviously you don't think that's true. It also, of course, there's a lot of connected here to the complexity of what you're building and how far you are, and the stage, the size that you're raising. Can you talk a bit about that? Just because it's there's a lot of unnuanced advice going around, and this is a sentence everyone will remember. So, true, false. When is it true? When is it not?
And maybe also, how does it shift from your earlier days to where you are now? Because you're in a different position at this point than when you just started and when you're doing your pre-seed, seed, even the A round probably.
Yes. So I think the sentence data rooms is where deals go to die. I think in the very early stages makes a lot of sense because you don't have anything in the data room. It's sort of like when you're like, I don't know, in high school or university and you have a LinkedIn profile and you're just trying to desperately put something onto that LinkedIn profile so you appear somewhat employable. That's kind of how I think about data rooms at pre-seed, seed stage. But then, the further you go, the more data you obviously have. And so then there is also the bar for what kind of diligence investors do just increases with every single round. The more money you raise, the more years of data you have, the more you will need to show that data and have that be scrutinized. So I would say that in your pre-seed seed phase, yes, the data room part is a bit of a joke. Just like modeling in your pre-seed seed phase is a bit of a joke. At Series A, there is certain quote unquote metrics, if you will, that in some ways make sense they make sense for software companies, right? The revenue targets, the whatever. For deep tech companies, they're kind of not really in sync with how deep tech companies are built. That's when, again, understanding of what really matters as momentum at what phase and how to show that momentum through your data room starts becoming important. So yeah, I'm a bit split on that because I would want to do diligence. I was typically a Series A investor. I would want to do some diligence, but the other side of it is that it is relationship based. It is about trusting the team. And one way to show that team is investable is to see their track record of delivering against plan. So one of the things that I would typically do, and I still love doing it, is, and this is what we have in our decks, is, typically you will want to see what was the previous deck, like the previous round's deck, what did they say they would do and what have they done? So in our deck, we have a page literally saying this is what we said we would do and this is what we've done with the Series A money. And that builds trust then. And they can go in and say, okay, yes, I can find all of these documents that say that, yeah, we have done it.
So you're very, very deliberate in your approach. And so in building a very complex solution, so we have chemistry and we have manufacturing and we have a financial vehicle that we haven't talked about yet with the carbon markets. But within all of this, there's also a very mixed capital stack that needs to come and support, and also a wide array of types of investors that you want to reach out to and give access here. So when you were building up from your, let's say, seed stage to your A, and then after that, how are you thinking of your mixed capital stack beyond VC, but also within VC and the different type of VCs?
So we were very deliberate. We are very deliberate with how we build our cap table, and also the capital stack, the diversified pool of finance instruments to finance different parts of this equation in the right ways, right? So our seed round, we were very adamant that we wanted to have some of the best focused climate tech investors in the world. We wanted to have a regional one here from the Nordics. I'm based in Sweden. So there we partner with Pale Blue Dot. Hi, Hampus. We love you guys. So that was one of the seed investors. Then we had another European long-term, this was important to us also, climate tech investor. We picked 2050 from Paris, Marie Eklund, hello, which is an evergreen fund. Again, not pressured to sell super fast. And then we also wanted to have somebody from the US, and one of the best names in the business at pre-seed seed phase is Grantham Foundation. So we have the Grantham Foundation, hi Mark von Keitz, that also backed us. And then it was a bunch of sort of our network friends from the entrepreneurial angel space that came in. So that was important to us. Then at Series A, frankly, we got so many no's in our Series A that we were like, what is going on? Like, why are we getting all these no's? And we started listening very intently to a lot of the no's, and they really were made up of two categories. One, and they were usually both categories, actually. So they said, so you want to move from batch to continuous under a high pressure process and replicate the chemistry. We're like, that sounds difficult. We don't think you can do it in the time that you say you can do it. Or we don't think you can do it full stop. That was the other side of it, which is kind of depressing. And then the other side was like, even if you could do it, who's going to buy this stuff? It's very regulated, very price sensitive, blah, blah, blah. So we thought, well, one side of that risk equation, we just got to do it, right? We have to build the tech. We can't not build the tech. And then the other side, we thought, can we create a financing round in which we cater to some of those risks that some of the investors see on the commercial front and show that there is interest in this solution? So we, together with our seed stage investors, in particular 2050, we designed something called the aligned value chain. And the aligned value chain is basically there to represent the demand side de-risking of this technology. So we mapped out our value chain. We said, okay, who would be selling to directly? That would be cement world. The cement world would sell into, or cement and concrete world would sell into general contractors, and general contractors would sell into real estate developers and eventually asset owners. So then we said, okay, who are the most ambitious in each of those categories that we can access, that also we can have very close collaboration with in each of the de-risking steps. So we were very fortunate that Amazon Climate Pledge Fund at the very end there at the asset owner, asset manager front came in and said, we as, building a lot of data centers, fulfillment centers, whatever, and have very high sustainability targets, we like the sound of this. We'd like to be a catalytic here. And then we thought, okay, what type of buyer or general contractors build for the likes of Amazon? We didn't at the time know, by the way, that they were directly working together because nobody knew this of us. But Family Goldback from Germany, that is behind the huge construction empire, primarily in precast, also wanted to come in. So that was also amazing. And then we have Holcim, one of the cement majors that has the highest number of CCUS projects. So they've decided between CCS and CCUS to go into CCUS. So that was the aligned value chain that we built. And then we thought also, okay, do we take another climate tech investor on the financial side, so not the strategic side? And we thought, no, actually, it seems like the world is changing. Let's put it this way, and we need to be held accountable on pure financial metrics. So we decided to bring in a pure play VC. We chose Capnamic from Germany. Hi, Christian and Christian. And we've partnered with them to have a very strong basis on the price competitiveness market side of things. So we have a very good balance between climate tech investors, finance, or sort of regular finance, VCs, and strategics. So extremely deliberate. That's one side. But Carmel, you didn't answer your other question, which I'll be fast. There's a very important capital stack design part of this equation. And this is true for most deep tech companies that are building something in the physical world. So there's really three main components to the finance mix. One is, of course, equity, but equity doesn't like to finance, for example, CapEx or very long-term R&D. So you got to figure out some kind of debt product, not venture debt, by that I mean project finance product that works for your type of a solution, and then complement that with whatever grants, subsidies, tax credits, and whatnot. It's very important that it's in that order. It's very hard, and we've seen this in the US, when you base your company on kind of expecting government grants and subsidies, and then you build your equity story on top of that, and then your debt story on top of it. If the DOE pulls back financing, we have a really big problem. And so we at Paebbl went kind of the other way around, and that's been very good for us.
I'd love to ask you about building momentum in a funding round. And I, of course, want to ask you this because, especially in deep tech, one of our main problems is a lot of really good founders and startups are able to get backing from EIC, but they're then not able to get the private investors to come in. And then that might cause a round to stall, so to say. You have a 50% commitment from EIC, but you can't get the rest to move. We see a lot of companies die in this period where they're raising and then they just cannot get the whole syndicate together, and then a great company ends up folding because of that. How do you, and obviously like some companies die because of, lack of product market fit, lack of blah, blah, blah. Sometimes it's just purely that you can't make it happen in good enough time. Can you talk about that explicitly? How do you think about building speed into a round?
It's a really hard question. And honestly, right now, I feel like it's a very hard market. I mean, I have not heard of anyone that's not in AI or defense that has closed their round in less than 6 months. The 9 months also fairly regular, some over a year. It is brutal out there. I think solving for speed is hard right now, but solving for, how to generate momentum with the right stakeholders at the right time is what I think you should focus on. So what do I mean by that? So the EIC financing, fantastic, but I think that should be very much the second component. I think you need to have your market interest first. And so then I think focusing on that market interest, all deep tech companies, unless they are science projects purely, should have somebody benefit from whatever it is that they're bringing to market. Strategics. I think strategics play an exceptionally important role right now. And so my advice to founders is to figure out what problem are you solving for whom, and might they have a vested interest of being on your cap table as you're solving that problem. And that way you bring also confidence to financial investors who are in any case going to be validating the market through references, existing customer references and market references. They are going to be calling up some of these people. So if you say, for example, when investors tell us, the cement world is not going to like this, I just tell them we have like the biggest cement company in the world as one of our investors, just talk to them. Similarly with the construction. So it's like, it really works well to have validation from those for whom you're solving a problem. So that's what I would focus. And the moment you get that right, the moment you start having those people say yes, getting the financial investors is easier. And then if it's sweetened with an EIC component, there being maybe to de-risk some of that financial ticket. It's not that it's de-risked, but it basically says the financial ticket can be smaller and still lead a round, and the round will come together. So that's kind of how I would see it. But hang in there because it is brutal.
But that is more for A rounds, right? Like at seed, it's a bit harder to connect with strategics. It can be possible, but
yes,
it's much more difficult. So sometimes we fall in. Sometimes the kind of valley of death comes on earlier because the strategics do pilots, but in the end, it doesn't really bring you the kind of traction.
Yes, I think that would make sense. Although I'm really not a fan of these bizarre letters, seed, A, B, C. I mean, when I started my venture career many years ago, there was no like this whole mega seed, mango seed, whatever, jumbo seed stuff. None of that stuff like pre-seed didn't even exist. It was called friends, family, and fools. And you raise like 300K. And that was it. And then your seed round was like, I don't know, $1 million, $1.5 million, something. Your A was, so these numbers or letters mean really very little. I think it's about what journey are you on and what proof points can you get at what stage. That's the most difficult thing in deep tech, is that you're building technology that just has time cycles. The best you can do, I think we're very privileged to be building right now, is that you can use basically modeling and AI and whatnot to accelerate some of those learning loops. So what you want to do is show how you're progressing faster than the market. And that, I think, helps bridge some of those gaps.
To kind of finalize this, because again, for deep tech, talking about debt financing, project financing, I think many of the founders can benefit a lot, and actually from investors as well, on how do you approach this? Because in the end, you're financing a project that is a future project, right? The product is still in development, there's offtakes. Most regular debt financiers don't do this. So how do you approach closing that gap?
It's hard, especially if you're not a TRL9 technology yet. And to get to TRL9 technology, there's quite a bit of capital that needs to be put into some of these cases. Not all of them, but some of them. There are instruments that are catalytic, I would say. There's catalytic capital that is there to fill some of these gaps. We're starting to see this, like the Grantham Foundation of this world or Breakthrough Energy, their non-equity instruments. Then you have the Schmidt Foundation and folks like that are there to fill some of these gaps. I highly encourage to founders to kind of find out about these vehicles and start talking to these entities. They're there to bridge the gaps. That would be my best advice. And then the second best advice is bring on board experienced team members that have raised diversified finance stack. Then make sure that they're heavily involved in how you design this maybe not from the get-go, but from quite early on. We did that, for example. We are big believers in recycling learnings from other companies. So we've hired a few people from both Northvolt and Stegra to really understand what worked, what could have been done differently, and then to build something hopefully a little bit better. And I'm sure, eventually the next generation of companies in this space will be hiring from us and doing something better as well. So that's just how talent recycling and knowledge recycling works.
I would love, before we close, to just try and extract as much as we can from you on how to diligence a VC, because you've been inside it. It's a bit of an accident to you almost. You're coming out of the industry, or for a while now, you've been out of the industry. What are the hacks that founders can use to really understand if this VC is going to be valuable, if what they're saying is true, if they're just taking you on for a ride, all these things? What are the core things that come to your mind?
References is always the number one thing. You want to get their direct references, and then you want to do what they will do for you on you as well. So you will give them your references, and what they're going to do is that they're going to take the derivative of that. They're going to take the next wave as well. So you want to do exactly the same thing. You want to figure out who you should be talking to that they're not telling you to talk to. You want to hear sort of cases of where things didn't go well as well, and how did they handle that situation. I think that is the most important thing. Like, yeah, I mean, if you've IPO'd a company together, everyone's going to be tapping each other on the shoulder. But if things haven't gone well and 50% plus of the cases are a bit bumpy, let's put it this way, or probably more than 50% of the cases, like 80% of the cases are bumpy at some point in time, you will want to know how do they deal with that side of things. So I think my specialty is doing references on people. I have all sorts of questions that I ask, and then there's subtleties in how people answer that can really tell you stuff. That's one. Then co-invest.
If I could just add a note on that, because it's one thing that you can ask questions and be smart about that. You also need to be able to take trusted references. Like, if you ask me about someone who I know and know is important and so on, if I don't know you, you will not get a super clear answer from me. So there's also a lot about that, and knowing how do you approach and who do you approach. And sometimes, what you should do is you should ask a person that's closer to you that will then ask on your behalf, because otherwise you're not going to get an answer you can truly trust.
Exactly. Yes, that's a very good reminder. Yes, absolutely. You either want to go and get that, you either want to go indirectly through a trusted source, or you want to have a trusted connection introduce you and say it's really important to this person to get the real scoop. And my experience, at least, is that this tends to work. I don't think that I have any example of an investor that we've done references on that has surprised us with something that, we didn't know about. So I would say that that's one. The other one is co-investor reference. So, I mean, this is kind of easier for me to do because I can call somebody else up and say, hey, I see you co-invested with this person. How do they behave? But I understand that that's more difficult maybe for non-former investors to do. And then I would, the other thing is that a lot of VCs, as part of the marketing and the sales, tell you, oh, we're going to do all these things. But the best VCs or the best investors, what VCs are not, are actually building value in the diligence process. The amount of introductions I've received to potential customers, partners, all sorts of things that we end up actually being partnering with has been astounding. So that's I think the best. Like when they actually volunteer to do something, and when they tell you that this one I really love. I love when I hear what's being told about us in the market. So when we hear from an investor saying, hey, I've spoken to so-and-so, this is what their take is, the good, bad, and the ugly, then at least like, okay, this is a completely unbiased market perspective that is fresh, that is relevant for me. So yeah, I think that's the holy trinity is taking references on founders directly on investors directly and indirectly, seeing whether they can build value already in the process itself, and then seeing if you can get understand from people who have co-invested with them how they behave.
I don't know if we have time, but you also have a very unique approach to how you're managing the company as a co-CEO. So maybe if we can talk about that for 2 minutes before we wrap up, that would be wonderful.
Sure. Yeah. So co-CEO-ship is becoming, I'd say, increasingly popular. I mean, even Jeff Bezos apparently is a co-CEO. I'd love to see how that actually works. But this is, so how did this idea come about? So in Northzone's portfolio, some of the best, actually, basically all of the best companies that we had in the portfolio were led by two people, either through, let's say, an executive chairman and a CEO, or co-CEOs, or CEO, COO, whatever, something. But it was usually two people that co-led the company. Some good examples are, for example, Spotify had that set up, not with co-CEOs. We had Martin and Daniel for a long time co-running the company. And iZettle as well, and then a couple of others. Sorry, Avito, for example, in the classifieds space. So all of them were run by co-CEOs or kind of co-leadership of some sort. And so then I started becoming curious on this topic and started looking into actually, how do companies do if they're co-led versus led by a single CEO? I had also seen a lot of the CEOs that I was working with just have a very hard time. It's a very, very lonely role. So then statistically, actually, co-CEO led companies do perform better in many cases, like if you can find those stats. And also from a mental health perspective, the co-CEOs are doing better. And that's why I said, Andreas and I started talking about it. So Andreas, my co-CEO, and I started talking about it and said, why don't we try this? It's going to be a very complicated thing to build. There's going to be highly technical things, highly commercial things, and to not end up being one of these science projects, let's build the technical and commercial at the same time. And at the same time, you're building a new team. And Andreas is amazing at building teams. So that's kind of how we went about it. We said it was going to be temporary and we said, let's try for 2 years co-CEO-ship and then see how we feel 2 years in, or 1.5 years in, do we continue? We did that. So we, at the 2-year mark, roughly, we recommitted to another 2 years of co-CEO-ship. And then we've just had that again. And now we're saying, okay, another 2 years. So we are very pragmatic about this. And it might be so that at some point, it's not even going to be one of us that's the right person to lead the company. So we will always do what's right for the company. And that might be a different leadership model in the future as well. But for now, it's working well.
Can you talk about VC reception on this? Because there's a lot of, not myths, but strongly held opinions around how do you need to structure this? And many would say, no, you need one final person that makes the call.
So we have turned down investors that have had very strong opinions on this topic. I like to argue and counter-argue situations with some data points. But when somebody just has a strong opinion, I have a hard time, having a productive conversation with that. So yes, it's not for every team. And yes, it's definitely not for every investor to work with co-CEOs. I think our investors, well, I certainly believe that they see the value of us. I mean, right now, for example, Andreas is on parental leave. I mean, when would a CEO be able to take more than a few days off on parental leave? And the house is still standing. And equally, in my now coming up to 18-year career, the first time ever in my career that I went on a holiday without my computer for a week was right after we closed the Series A. That would never have ever have happened if I were the sole CEO. So I think our investors are seeing that it's a relay between Andreas and me, and that works really well. And I believe with how many companies, even large companies, have started embracing co-CEOship. I think we're starting to see more of a norm form around this, and I bet it's going to be much more standard in the coming 5 years.
Marta, final question, because we're running out of time, because we could talk about this forever. I noted down that maybe we should actually do an episode on the rise of co-CEOs, because I think it is really important, especially from a mental health perspective. I'd love to ask you, if you think back at your Northzone days, do you think that you actually had a practice of co-CEOship without it being delineated as such in the hierarchy?
I actually think so. So, I mean, the very simple fact is that we would never back a single founder. So you would always have co-founders, and then they would always be in the same, I don't know, they're like the same category. And if they weren't, if you had, like, Carmel, you raised this in your intro, when you have a symbolic female co-founder that owns like some tiny little percentage just to have the title, you can smell this like in all sorts of cases, not even just between the kind of the gender balance thing, but just if co-founders own similar amounts, they're going to have a very different relationship between themselves and how they talk formally, externally, and also informally. So yeah, so this notion of shared leadership is there. I mean, you're a tribe, you're kind of a family in a sense, in trying to bring this like little nascent thing to life. So yes, I would say it's always been there a little bit.
Marta, Carmel, this has been an absolute joy. We will do that episode at some point about the rise of co-CEOs. I think it's very important. Thank you, both of you, for having put all the work into doing this episode. It's really meaningful. Thank you so much.
Thank you so much. Thanks for having me. Have a great day.